Now, to start us off, we've just heard about the CFC Stanbic results, which just came out this morning, and they've reported about close to 40% growth in pre-tax profits. Your analysis of this?
As you've seen how the trend has been in the last 2 weeks when banks have been, the financial stocks have been releasing the results, is that banks have really been, raking a lot of profits. And CFC wasn't actually going to be an exception, especially given the fact that in the last years it's rebranded itself. It's done a lot of serious expansions. It's been able to coalesce a lot of units, the life insurance, the banking division, and also we saw that it actually realigned its investment wing, and especially the brokerage division of the stock market. So this was expected. However, we know that it's one of the banks that actually its efficiency ratio is a bit low because of the expansion issue. They've been trying to do a lot of expansion, and this means that a lot of their operating costs has actually gone up. So the 40% in terms of revenue growth was actually expected. However, this is actually now raising a lot of questions in the industry, whereby many people are asking, should the issue of loan rates actually be reduced, because the customers are complaining a lot. The burden of repayment the loan is high. The rate of default is actually high. But you see, banks are actually happy, laughing all the way to the bank, and especially this is the post-tax, profits. Mm-hmm. But it shows that there's a lot of opportunity in the industry for growth.
Mm-hmm. Talking about still on the CFC counter, and they actually moved to Southern Sudan in the month of June, and they're looking at regional expansion. Just take us through why the Kenyan farms as well as the banks are really looking into growing their base.
It becomes the third farm to actually now head into South African. Seriously, because Southern Sudan. One, because of the oil industry. It's a huge segment, and we know that the financial transactions for oil in Southern Sudan have not yet really been farmed yet. We don't know the procedure of how the country is going to deal with its oil issue. So we see that a lot of our banks actually heading there. Especially in terms of providing key services, in terms of transaction, in terms of payment, in terms of offering credit for emerging business. So there's a lot of business opportunities, and they're not actually, they're looking for credit to expand. So we see this as one of the reasons why the bank has seen its serious investment options in the region.
And Biko just mentioned about the cost-income ratio, and you saw Standard Chartered Bank, which reported an 88% growth in pre-tax profits. It had the cost-income ratio going down to 38% compared to 48% in the first half of last year, year on year. But this is very low compared to what the industry has. If you look at the KCB, if you look at the Barclays, look at the equity, they're still at 50% plus. How come they're able to to tap into this?
One, you need to understand that it all depends on how the strategy of the bank is. Your expansion plans, where you're planning to go, and how you're going to look at your human capital resources to be able to mitigate this. Two, how you're going to be able to relate in terms of making it convenient for you to be able to serve your customers. And you see the bank has been able to actually work on this. And as there's the farm on the plans for the region, we see even this going lower and them being able to actually maximize on the return on assets.
Mm-hmm. Another counter on the radar, Biko, is Standard Group, and it reported, their profits actually declined by about a half compared to what they reported in the first half of the period in 2011. And compare this to Nation Media Group, which reported a 23% pre-tax profits. What exactly is going on here?
One, I think we need to be fair to Standard Group in terms of a comparison, because we can't really compare them to Nation Media Group. One, the regional expansion the regional operation expansion for Nation Media Group is huge. And we know it actually operates in almost all the East African countries. Mm-hmm. And then second, we need to understand that our Standard Group has really done a lot of expansion in the last 1 year, moved to new offices, they've set up a new digital division. So we've been able to see that a lot of the money has gone into expansion, which means a lot of resources in terms of human capital, assets, strategy to be able to deliver to customers. They've come up with new products, new newspapers in the market. So we see that despite the fact that their profits have declined, we're seeing the stock market being one to watch, especially in the coming quarter, given the fact that now the return on assets for what they've been able to put in place is actually going to be key. And also we need to understand that we need to look at the expansion in the region, where they're actually operating compared to Nation Media Group. And once we get that, we're able to tell that unless we're going to break it down in terms of operational cost and return on investment per division, then you can go to look at exactly how the Standard Group has been. But I think in my books they've done pretty well, given the fact that they've had a lot of challenges, especially in the expansion, and where they're sitting currently right now has been a land that's been disputed. So for them, and then also you also need to understand that it's been a house. Most of the investment has been in human resource, and we've seen that most of the key human capital has been poached. So this is another issue that has actually set them back at least by 7%.
Speaking of challenges, Biko, and you saw Scan Group reporting 11% year-on-year first half profit growth compared to 96% which it had in the previous period. And just take us through why the difficult moments.
One, I was actually surprised when the Scan Group actually did announce the results, because we expected for them to do better. But then we realized that having been a monolithic kind of group in the industry, it owns almost more than 50% of the media agencies in the region. And then we're able to see that other players have come into the industry, other players who come to come and actually take advantage of the complacence. We're seeing international firms coming to pitch camp in the country. We're seeing international firms actually coming and taking away their key of the business. So this is something that they need to actually look at, being able to lock in the clients, being able to lock in the businesses. And given that it's a political year, we expect a lot of fireworks and a lot of revenues to be done. And also we're also trying to see that it runs a business that's actually affected by the media. We're looking at National Media Group, we're looking at Standard Group. And so how these other media houses perform in their key business will also affect how they perform. But we need to understand that competition in the advertising and marketing business has actually gone a notch higher. We were now working on international standards, we're having international firms working here. So unless, and then we also need to understand that since it owns a lot of media agencies, the aspect of operational costs are up, because it needs to still streamline how they are going to work, how they're going to relook at its issue of human capital, to relook at the issue of reducing costs, and then also the aspect of just basically how they're operating. They're all over the place. They need to actually centralize their business to be able to maximize on returns.
Access Kenya is also one of the counters that released the results last week, and it was up 14.8% for the first half of the year, and it closed Friday's session at 490 shillings. Will you be buying at this price this morning?
No, because for me, in my books, looking at the fundamentals for Access Kenya, looking at how its market share has been, for me, it's a sell. In the fact that there's a lot of competition in the industry. We're looking at a lot of telcos actually doing what it's doing and doing it better. We're looking at, when you look at the market share for Access Kenya is the high-end kind of clientele. And these are people that other players in the industry actually getting into. So the key aspect of the fundamentals for it are for sale. And as much as it did post good results, a lot needs to be done, especially in its management, and how they can be able to look at the middle and the lower class in terms of the market share.
Another company still on the radar is Kabaseed. It's expected to release its interim results anytime this month, and it was up 5% by the close of Friday. What's your sentiment on this stock?
One, liquidity of the stock price, the market is low. So if there's any show of interest in the share, we'll actually see that the company goes up. However, given the fact that it operates within an industry that's limited to players, the results should actually be good. Should actually be better than last quarter. But also the fact that not so much information is out on it, and especially on management and what are the key players or key partners in the industry. This is one stock that many people actually want to get into, but because of limited supply of shares.
Safaricom, which is up 32% this year, was one of the leading losers on Friday. It actually lost 2.6%, but the analysts were saying that probably it could head to the 4 shilling mark. Do you share those views?
No. One, as I've always said before, that the Safaricom being the biggest player, on any given day is a mover, whether it's losing or whether it's gaining. And what we need to realize that Safaricom needs to consolidate its shares for it to be able to go to the 4 shilling mark and actually try to appreciate from there. Unless this happens, it will continue, being a pendulum kind of stock. It's the only pendulum stock in the market.
Briefly, Biko, your stock picks for this week?
KCB, Stanchart, CFC Stanbic.